Okay, besides looking for low debt and cash-rich businesses, the next thing you'll want to consider is the quality of a company's management. In most cases, a company is only as successful as the people running it, and a big part of value investing is making sure that the business you buy into has a reliable, experienced, and forward-thinking management style behind it. One of the key factors in determining whether or not a business is on top of its game is to have a look at what gives it its competitive edge in the marketplace, and whether or not its management team has an ongoing plan in place for making the most of this competitive advantage. This means that management is not only acknowledging the competitive challenges that constantly threaten their company, but is adapting and responding to those challenges in a realistic and timely manner. To determine how well a company's management is doing in operating and expanding their business, you can use some efficiency ratios. And another great way to evaluate the quality of the management is looking at their company's competitive advantages. You need to make sure, to the best of your ability, that the people you are trusting your money with have proven themselves as effective decision makers and leaders within their industry. We'll dive deeper into how to identify a company's competitive advantages in the next module. Great companies should have great management teams. A great management team should focus on generating growth over time, which is the best way to reward long-term shareholders like yourself. So make sure you keep in mind principle number 4. Only look for companies that have both strong management and a sustained competitive advantages. And see you in the next video. Okay, let's talk about principle number 5. If you want to become a successful value investor, avoiding losses should be your first priority, even over generating investment gains. Remember rule number 1, never lose money. And rule number 2, never lose money. And I can tell you rule number 3 and number 4. Again, never lose money. Here's an interesting fact. It's simple math. If your portfolio's value drops by 20% and then grows by 20%, you've lost money. More to the point, in that situation, you need larger returns to meet your goals over time. That might lead you to take larger risks than you should, which could lead to more losses. As a value investor, you can minimize the risk of big losses by investing at a discount to a company's intrinsic value. And that's why you need to use the margin of safety as a part of your valuation process. Well, you may not always get market-beating growth, but if you can minimize losses and the need to recover from those losses, you'll need less growth to meet your investing goals over time. And besides giving yourself a high margin of safety, there are many ways you can go about minimizing losses on your investments. For example, you can easily avoid common costly mistakes like overtrading by only investing in companies that you're sure that you'll make a profit with. And before making any trade, you should always have an entry and exit strategy in mind. And don't forget to place a stop loss to protect your money. Okay, that's principle number 5. Never lose money. See you in the next video.